Let me ask you something that might make you uncomfortable. When was the last time you actually looked at what your retirement account can buy? Not the number on the statement, I'm talking about real purchasing power. Because while that number might look stable or even growing, there's something happening right now that's quietly eroding what those dollars will actually do for you when you need them most. I've been tracking precious metals markets for over 2 decades, and I'm watching something unfold that I've only seen twice before in my career. The last time this pattern emerged was right before gold went from 800 to 1,900 in less than 3 years. But here's what's different this time, and why retirees need to pay attention right now. Central banks just bought more gold in the first half of this year than any 6-month period in history. We're talking 483 tons. That's not a typo, 483 tons of physical gold, purchased by the very institutions that print money. Now, why would the people who control the printing presses be converting their own paper into metal at record pace? The answer is sitting in plain sight, but most people aren't connecting the dots. Let me walk you through what's actually happening, because this affects every single person with money in a bank account, a 401k, or an IRA. Start with this fact. The dollar has lost 97% of its purchasing power since 1913. You've probably heard that statistic before. But here's what they don't tell you. Most of that decline happened in specific, concentrated periods, not gradually over time. We're talking about sudden drops that caught people completely off guard: 1,933, 1,971, 2008. And if you look at the data we're seeing right now, we might be standing at the edge of another one of those moments. I want you to imagine something. It's 1970. You're 65 years old, freshly retired with $100,000 in savings. That's serious money. That's a house paid off and a comfortable retirement ahead. You've done everything right. Worked hard, saved diligently, followed all the conventional wisdom. Then, August 15th, 1971 happens. Nixon closes the gold window, ends the Bretton Woods system. And over the next 9 years, your purchasing power gets cut in half. Not because you spent it. Not because you made bad decisions, but because the rules of the game changed overnight. The people who saw it coming, the ones who moved even a portion of their wealth into gold before that shift, watched their $100,000 grow to $800,000 by 1980. Same decade, same economic conditions, completely different outcomes. The only difference was understanding what was happening and positioning accordingly. Now here's where this gets personal for anyone in or near retirement today. We're seeing the exact same setup, but on a scale that makes the 1970s look like a practice run. The federal debt just crossed $35 trillion. That number is so large it's almost meaningless to most people. So let me put it in perspective. The interest payments alone on that debt are now larger than our entire defense budget. We're paying more just to service the debt than we spend on the military. And those interest payments are accelerating because rates went from 0 to over 5% in less than 2 years. This creates what economists call a debt spiral. Higher rates mean higher interest payments. Higher interest payments mean more borrowing. More borrowing means even higher rates. And there are only two ways out of a debt spiral: default or inflate. The United States has never defaulted on its debt, but it has inflated away the value of that debt multiple times throughout history. And every single time it does, the people holding cash and bonds are the ones who pay the price. But here's what's different this time. In the 1970s, it was just the United States dealing with inflation. Today, it's global. The European Central Bank is dealing with the same problem. The Bank of Japan just ended decades of negative interest rates because inflation finally forced their hand. China is quietly accumulating gold while reducing their holdings of U.S. treasuries. This isn't a U.S. problem anymore. This is a global monetary system problem. And the central banks know it. That's why they're buying gold at record pace. The People's Bank of China has been adding to their gold reserves for 17 consecutive months. Poland just announced they're increasing their gold reserves to 20% of total reserves. That's a massive allocation for a central bank. Singapore, India, Turkey, they're all doing the same thing. These are the institutions with access to every piece of economic data, every classified briefing, every insider conversation. And they're converting paper into metal as fast as they can. Now you might be thinking, okay, but I'm not a central bank. How does this affect my retirement? Let me show you exactly how this plays out for regular people. Think about your retirement account right now. Let's say you've got $500,000 saved up. You've been contributing for 30 years. You've weathered the dot-com crash, the 2008 financial crisis, the COVID panic. You're finally at a point where you can see the finish line. That $500,000 is supposed to generate income for the next 20 or 30 years of your life. But here's the question nobody's asking. What happens to that $500,000 if we see even half the inflation we saw in the 1970s? Back then, inflation peaked at 14%. Today, official CPI numbers say we're around 3%. But if you actually calculate inflation the way it was measured in 1980, we're already over 10%. They changed the calculation methodology multiple times since then, always in ways that make the number look smaller. Substitution effects, hedonic adjustments, all these technical terms that basically mean we're going to measure this differently so the number doesn't look as bad. But you can't eat a CPI calculation. You can't pay your electric bill with a hedonic adjustment. You know what real inflation is because you see it every time you go to the grocery store, every time you fill up your gas tank, every time you get your property tax bill. The official numbers might say 3%, but your actual cost of living is going up a lot faster than that. So back to that $500,000. If real inflation runs at 7% for the next decade, which is actually conservative compared to the 1970s, your purchasing power gets cut in half. That $500,000 buys what $250,000 buys today. And if you're taking distributions during that time, the math gets even worse because you're selling assets in a declining purchasing power environment. This is the silent retirement killer that nobody talks about. It's not a stock market crash. It's not a recession. It's the slow, steady erosion of what your money can actually do. And by the time most people realize it's happening, they've already lost years of purchasing power that they can never get back. Now here's where gold comes into the picture, and why the timing of this matters so much right now. Gold isn't an investment in the traditional sense. It doesn't pay dividends. It doesn't generate cash flow. What gold does is maintain purchasing power across time and across currency crises. An ounce of gold bought roughly the same amount of goods in ancient Rome as it does today. That's 2,000 years of purchasing power stability. But more importantly for retirees, gold has a specific behavior during the exact conditions we're seeing right now. When real interest rates go negative, meaning inflation is higher than the interest rate you can earn on safe assets, gold goes up. Not sometimes. Every single time in history. Because at that point, holding cash or bonds means you're guaranteed to lose purchasing power. Gold becomes the only way to preserve what you have. And we're in negative real rates right now. The 10-year Treasury yields about 4.5%. Real inflation, measured honestly, is running over 7%. That's a negative 2.5% real return on the safest asset in the world. You are guaranteed to lose purchasing power holding treasuries right now. The only question is how much. This is why gold has quietly moved from $1,800 to over $2,600 in the last 18 months. It's not speculation. It's not retail investors piling in. It's institutions and central banks recognizing what's coming and positioning accordingly. And here's the critical part. We're still in the early stages of this move. Let me show you why. In 1980, when gold hit its previous inflation-adjusted peak, it represented about 5% of global financial assets. Today, even after this recent run-up, gold represents less than 1% of global financial assets. If gold just returned to its historical average allocation, we're looking at a 5 times increase from current levels. That would put gold over $13,000 an ounce. And that's not a prediction. That's just math based on historical norms. But here's what makes this even more compelling for retirees specifically. You don't need gold to go to $13,000 for it to do its job. You just need it to maintain purchasing power while everything else is losing value. If inflation runs at 7% and gold appreciates at 10%, you're not getting rich. You're just preserving what you already have. But in a high inflation environment, preservation is victory. Let me tell you about something that happened in 2008 that most people don't remember. When Lehman Brothers collapsed and the financial system was melting down, gold dropped initially. It went from $1,000 to $700 in a matter of weeks. And everyone said, see, gold doesn't work as a safe haven. But here's what actually happened. That drop was forced liquidation. Hedge funds and institutions had to sell whatever they could sell to meet margin calls. Gold was liquid, so it got sold. But then something interesting happened. Within 6 months, gold was back over $1,000, and it kept going. By 2011, it hit $1,900. Because once the immediate panic passed, people realized the response to the crisis was going to be massive money printing, and they were right. The Fed's balance sheet went from $800 billion to $4.5 trillion, and gold went up 170% from the bottom. Now look at what happened during COVID, same pattern. Gold dropped initially when everything was being sold. Then it went from $1,500 to $2,070 in less than a year, because the response was even more money printing. The Fed's balance sheet went from $4.5 trillion to $9 trillion, trillions of dollars created out of thin air. And gold did exactly what it's supposed to do. It maintained purchasing power while the currency was being debased. We're in the third act of this play right now. The debt is higher than it's ever been. The interest payments are accelerating. The political will to cut spending doesn't exist. And the only tool the Fed has left is the printing press. They'll call it quantitative easing or liquidity provision or whatever technical term makes it sound responsible. But it's the same thing, creating money to pay debts. And every time they do it, the purchasing power of existing dollars goes down. Quick aside here, because this is relevant, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs actually work. It's in the description below. Covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, what the costs actually are, how the storage works, all the details they don't tell you in the sales pitches. Worth checking out if this is something you're considering for your situation. Anyway, back to where this is headed. Because the gold story is only half of what's happening. Silver is the other piece that most people are completely missing. And if you understand the silver market, you understand why we might be looking at the biggest wealth transfer in modern history. Silver trades at about $31 an ounce right now. The gold to silver ratio is sitting around 84 to 1. That means it takes 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1, and there have been periods where it's gone as low as 15 to 1. But here's what makes silver different from gold, and why the setup right now is so explosive. Gold is primarily a monetary metal. About 50% of gold demand comes from investment and central bank buying. It's a store of value. Silver is different. About 60% of silver demand comes from industrial use. Solar panels, electronics, electric vehicles, medical applications. Silver is consumed in industrial processes. It doesn't get recycled the way gold does. Once it's used in a solar panel or an electronic component, it's gone. And here's the problem. We're using more silver than we're mining. The silver market has been in a supply deficit for 3 consecutive years. We're drawing down above-ground inventories to meet demand. And demand is accelerating because of the green energy transition. Every solar panel requires about 20 grams of silver. Every electric vehicle uses about twice as much silver as a conventional car. The world is mandating more solar, more EVs, more electronics, all of which require silver. But silver mining isn't increasing. In fact, it's declining. Most silver comes as a byproduct of copper, lead, and zinc mining. Only about 25% of silver comes from primary silver mines. So silver supply is tied to the economics of other metals. And with energy costs up, labor costs up, and ore grades declining, it's getting more expensive to produce silver, even as demand is surging. This creates what's called a supply squeeze. And when you have a supply squeeze in a market as small as silver, the price moves can be violent. The entire silver market is worth about $1.4 trillion. That's smaller than Apple's market cap. It's a rounding error in global financial markets, but it's critical to industrial production. And when industries need silver and can't get it, they'll pay whatever it takes. We saw a preview of this in 2011. Silver went from $18 to $49 in less than a year. That's a 172% gain. And that was before the green energy transition, before the EV mandate, before the solar boom. The supply-demand fundamentals are exponentially tighter today than they were in 2011, and we're starting to see the same price behavior. Silver has gone from $22 to $31 in the last year. That's a 40% gain, while most people weren't paying attention. But here's what's really interesting. The ratio between gold and silver is still at 84 to 1. If that ratio just returns to its historical average of 60 to 1 and gold stays flat, silver goes to $43. That's another 38% gain from here. But if gold continues higher, which all the monetary data suggests it will, and the ratio compresses, which the supply-demand fundamentals suggest it must, you're looking at silver potentially over $100 an ounce within the next few years. Now, I'm not telling you this to get you excited about making money. I'm telling you this because if you're retired or near retirement, you need to understand what's happening to the monetary system and position accordingly. The traditional 60-40 portfolio of stocks and bonds worked great for 40 years because we were in a declining interest rate environment. Rates went from 15% in 1981 to 0% in 2020. That entire period was a tailwind for both stocks and bonds. But that trade is over. Rates bottomed in 2020. They're going higher from here, not because the Fed wants them higher, but because the market is demanding higher rates to hold depreciating currency. And in a rising rate environment, bonds lose value. The traditional safe haven for retirees isn't safe anymore. A 60-40 portfolio lost money in 2022 for the first time in decades. Both stocks and bonds went down together. That's not supposed to happen. But it did because the underlying conditions changed. This is why allocation matters so much right now. I'm not suggesting anyone put their entire retirement into gold and silver. That would be reckless. But having zero exposure to hard assets in this environment is equally reckless. Even a 10 to 20% allocation to precious metals can provide meaningful protection if we see the kind of monetary instability that all the data is pointing toward. Think about it this way. If you have $500,000 in retirement savings and you allocate 10% to gold and silver, that's $50,000. If precious metals double while everything else stays flat or declines, that $50,000 becomes $100,000. Your total portfolio is now $550,000 instead of $500,000. But more importantly, you've maintained purchasing power while everyone else is losing it. That's the real value. Not getting rich, just not getting poor. And here's the thing about precious metals in a retirement account. You can hold physical gold and silver in an IRA. It's called a gold IRA or a precious metals IRA. The metal is held by a qualified custodian. You maintain the tax advantages of the IRA structure, and you have direct ownership of physical assets instead of paper promises. When you take distributions, you can take them in metal or in cash. You have options. This is different from holding a gold ETF or a mining stock. Those are paper assets that track the price of gold. But in a real crisis, paper assets have counterparty risk. The ETF has to actually have the gold it claims to have. The mining company has to stay in business. Physical metal in your name, held in allocated storage, has no counterparty risk. You own it, period. Now, let me address the elephant in the room. Gold and silver can be volatile. They go up and down, sometimes dramatically. In 2013, gold dropped from $1,900 to $1,200. That's a 37% decline. People who bought at the top and sold at the bottom lost a lot of money. But here's what you need to understand about that decline. It happened because the Fed convinced everyone that inflation was under control and they were going to normalize policy. Taper the money printing, raise rates gradually, return to normal. And for a while it looked like they might actually do it. Inflation stayed low. The economy recovered. Rates started to rise. Gold went down because the conditions that drive gold higher weren't present. But what happened next? They couldn't normalize. Every time they tried to raise rates or reduce the balance sheet, something broke. The repo market seized up in 2019. COVID hit in 2020. And they went right back to printing money on an even larger scale. The point is, gold and silver are volatile in the short term. But over the long term, across decades and centuries, they maintain purchasing power. And in periods of monetary instability, which is what we're in right now, they outperform everything else. You just have to have the right time horizon and the right expectations. If you're 70 years old and you need to take distributions next year to pay your bills, putting a large portion of your portfolio into precious metals might not make sense. The volatility could hurt you in the short term. But if you're 60 or 65 and you're looking at a 20 or 30-year retirement, having meaningful exposure to hard assets is probably the most prudent thing you can do. Because the monetary instability we're seeing isn't going away. It's accelerating. Look at what's happening with the BRICS nations: Brazil, Russia, India, China, South Africa. They're actively working to create an alternative to the dollar-based system. They're settling trade in their own currencies. They're accumulating gold. They're building payment systems that bypass SWIFT. This isn't conspiracy theory. This is official policy that they're announcing publicly. Now, will they succeed in dethroning the dollar? Maybe not completely. The dollar has enormous advantages. It's the most liquid currency. It's backed by the largest economy and the strongest military. But it doesn't have to be completely dethroned for this to matter. If the dollar goes from 60% of global reserves to 40%, that's a massive shift. And all those dollars that were sitting in foreign central banks come flooding back to the United States. That's inflation. That's dollar devaluation. That's exactly the environment where gold and silver thrive. And this is already happening. The dollar's share of global reserves has been declining steadily for the last 20 years. It's gone from over 70% to about 58% today. That might not sound like much, but we're talking about trillions of dollars in shifts. And the pace is accelerating. Countries are diversifying away from dollars faster now than at any point in the last 50 years. This is the macro backdrop that most financial advisors aren't talking about. They're still operating with the playbook from the 1990s and 2000s: buy stocks for growth, buy bonds for safety, rebalance annually. But that playbook was written for a different world. A world where the dollar was unquestionably dominant, where inflation was low and stable, where interest rates were declining. None of those conditions exist anymore. We're in a new paradigm, and the people who recognize it early and position accordingly are going to be fine. The people who keep doing what worked for the last 40 years are going to watch their purchasing power evaporate. It's not about being smart or dumb. It's about recognizing when the rules have changed and adapting. Here's my challenge to you. Go look at your retirement statement. Look at the actual allocation. How much is in stocks? How much is in bonds? How much is in cash? And then ask yourself honestly, if we see inflation run at 7 to 10% for the next 5 years, what happens to that portfolio? Can you afford to lose 30 to 40% of your purchasing power? Because that's what's at stake here. I'm not saying sell everything and buy gold. I'm saying understand the risks you're taking by having zero exposure to hard assets in an environment where every single indicator is pointing toward monetary instability. The central banks are telling you what they think by buying gold at record pace. The bond market is telling you what it thinks by demanding higher yields. The commodity markets are telling you what they think by pricing in sustained inflation. The only question is whether you're listening. Because this window won't stay open forever. Once inflation becomes obvious to everyone, once the dollar devaluation is undeniable, the price of protection goes up dramatically. Gold at $2,600 might look expensive today, but if it goes to $5,000 or $10,000, today's price will look like a gift. Same with silver at $31. If it goes to $100 or $200, you'll wish you'd acted when it was still in the 30s. This isn't about timing the perfect entry. It's about having appropriate exposure before the shift becomes obvious to everyone. Because by the time it's obvious, it's too late to position your buying at the top along with everyone else who finally figured it out. So here's what I'd suggest. Take a serious look at your retirement allocation. Talk to a qualified advisor who understands precious metals, not just stocks and bonds. Understand the mechanics of how gold IRAs work. Look at the tax implications. Understand the costs. And make an informed decision based on your specific situation. But whatever you do, don't ignore this. Don't assume the next 20 years will look like the last 20 years. Because all the evidence suggests they won't. The debt is too high. The money printing is too extreme. The geopolitical shifts are too significant. Something has to give. And when it does, the people who prepared will be fine. The people who didn't will be asking why nobody warned them. I'm warning you now. The data is clear. The pattern is obvious. The central banks are showing you what they're doing. The only question is whether you're going to act on it or wait until it's too late.